This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this class, we will use the excellent text from Brigham and Davis, Intermediate Financial Management. In this lecture, we will cover the second half of Chapter 1, Overview of Financial Management and the Financial Environment. During the last 100 years, there have been three different major cycles of banking failures. Here in the 1930s during the Great Depression, the second one in the late 80s and early 90s that we call the savings and loan fiasco, and the final one here, 2008, 2009, 2010, etc., called the Great Financial Crises. Each of these were largely caused by the United States Federal Reserve System, but the operation mechanism for these failures was different. During the Great Depression, banks were allowed to take in deposits from individuals and speculate in the stock market. The Fed printed a lot of money in the 1920s, causing the stock market bubble. They started decreasing the amount of money printing in the late 20s, and that caused the stock market to start to drop. Since people were massively leveraged into the stock market, say 10% equity, 90% debt, a small drop resulted in margin calls, which created further drops, which created more margin calls, which created further drops, which caused all the banks that were speculating in the stock market to go bankrupt and lose their depositors' money. One of the so-called solutions to this was the Glass-Steagall Act, which split commercial from investment banking and no longer allowed commercial banks that take your deposits to speculate in the stock market with it. The second one here is more complex. The cause of the savings and loan fiasco was so-called a duration mismatch. Savings and loans take in depositors' money and buy long-term debt instruments with it. As interest rates go up, the value of those debt instruments go down, which, since banks don't have a lot of equity, wiped out the equity of the banks. And the final one here, well, again, banks are heavily leveraged instruments. They loaned to individuals buying homes, again, very high leverage. Banks don't have a lot of equity, and the homeowners they were loaning to don't have a lot of equity. So they made loans to these homeowners that were variable rate. As interest rates go up, the homeowners were not able to pay their debts, defaulted on the homes. The banks, therefore, lost money through that mechanism. Whereas most of the home loans made in the savings and loan fiasco were fixed-rate home loans. Most of the loans made during the housing crisis were variable-rate home loans. Looking at each of these crises in more detail, we will start by discussing the way banks and savings and loans operate. If we look over here at the equity to assets ratio, this is Citigroup, one of the biggest banks that went bankrupt during the housing crisis. They only have 9% equity, so 91% debt. It's very easy to go bankrupt if you don't have any equity, and under the Tier 1 and Tier 2 capital regulatory requirements, banks aren't required to have a lot of equity. This creates a moral hazard problem since depositors are guaranteed to get their money back through FDIC, and then the banks can take on a lot of risk and make money, and the taxpayers are stuck with the losses. This heavily leverage allows them to make a lot of money off very little return on assets. So here we have the return of assets of Citigroup of only 0.33%, but since they are so massively leveraged, their return on equity is close to 4%. If we look throughout U.S. history, one of the big early arguments was the creation of the Federal Reserve System. You can see throughout U.S. history, most of the time this line is flat. This is the general price level as a function of year. So the derivatives or change in this price level is what we call inflation. We've had a lot of inflation post-World War II, but very little inflation comparatively from the beginning of the U.S. up until that time period. At the beginning of the U.S., there was an argument between Alexander Hamilton and Thomas Jefferson over whether we should have a central bank. Alexander Hamilton worked with George Washington during the Revolutionary War. Washington sided with Hamilton, creating the first national bank. The Jeffersonians, and therefore Madison and Monroe, hated the idea of central banking. So when the charter for the central bank was up under Madison's term, he let it expire. But then the War of 1812 broke out, the British burned the White House, and he decided it might be a good idea to have a central bank to pay soldiers to finance wars. One of the primary purposes of printing money is to finance wars. So we got this little bump in inflation during the War of 1812. After that, during the presidential term of Andrew Jackson, the second bank was eliminated. Jackson hated banking. He went to war with Nicholas Biddle, the head of the bank. Nicholas Biddle claimed he would destroy the U.S. economy, blaming it on Jackson to get Jackson voted out of office. He was not successful. Jackson won, and the U.S. did not have a central bank from the Jackson administration until the creation of the Fed in 1913. Therefore, Lincoln financed the Civil War by printing greenbacks. Paper money is always used to finance war. The Fed was created in 1913, did immediately what central banks always do, printed a lot of money, causing this inflation here, and more importantly, causing the stock market bubble in the 20s, which we mentioned when the Fed cut down on money printing, caused the crash in 1929. The gold standard was in effect until 1933. Individual Americans used gold coins and silver to pay their debts and for general currency. In 1933, FDR outlawed the ownership of gold, and individuals were not allowed to own gold again for investment purposes until Nixon defaulted on the second gold standard in '71. So the individual default to the gold standard was 33. After World War II, something called the Bretton Woods Agreement was created, and that was used for an international gold standard to manage the currencies. If, for example, the French after World War II wanted to, they could demand turning in their dollars for gold, and the New York Fed managed this system, and they would move gold from the jail cell in the basement of the New York Fed that held the U.S. gold to the jail cell that held the French gold. The French did this continuously in the 60s, and eventually Nixon defaulted on the gold standard because the U.S. didn't have enough gold to cover it. Again, from the Federal Reserve printing too much money. Here we show FDR signing the Glass-Steagall Act in '33, which split up investment and commercial banking, and did lead to more stability in the banking system, although probably the best approach would have just been to get rid of the central bank again and go back to a gold standard. During the Great Depression, while we had a central bank, they did not target a Fed funds rate. They, in fact, really didn't even understand monetary policy in the modern term. As the economy contracted, they contracted the money supply, whereas today, if the economy contracts under Keynesian economics, they believe they should expand it. Here we can see the Fed funds rate, or the overnight lending rate, which is one of the main Keynesian mechanisms to target and control the economy, also believed in by the monetarists. And you can see it is very unstable, and they move it up and down continuously. During the 1980s, at this peak here, this was Paul Volcker massively increasing interest rates to try and fight inflation. We will see that inflation increased drastically during the 1960s as the Fed printed a lot of money that did not have gold to back to finance Lyndon Baines Johnson's Great Society program and the Vietnam War. By the late 60s, it was obvious that this was a problem, and the Fed started raising interest rates to try and fight inflation, but this always created recessions, so they backed off, particularly during election years, and then raised it again backed off during election years, and then finally increased it drastically after Jimmy Carter appointed Paul Volcker to the Fed, causing a pretty significant recession, guaranteeing Jimmy did not get reelected, but getting inflation under control. We will look at this again, in particular, when we talk about the housing crisis here in 2007. This is a blow-up of long-term interest rate from a former version of your textbook. And we can see here they also have inflation on bars. Inflation in the U.S. picked up drastically during the 1960s as the Federal Reserve printed money again to finance the Vietnam War and the Great Society program. This resulted in the French calling the U.S. on the Bretton Woods Agreement. The dollar was supposed to tied to $35 an ounce of gold, and the U.S. could no longer support that. So Nixon finally just gave up in '71 and said, we default on the gold standard. He actually said it was temporary, but of course we never got back to it. And, well, that eliminated the international gold standard, the Bretton Woods Agreement. Soon after that, individual ownership of gold in the U.S. was relegalized. So instead of restraining the Fed, they tried other methods to fight inflation. Nixon outlawed inflation by putting in price controls in the early 70s. That resulted in a temporary drop in inflation, but of course did what price controls always do, caused shortages. He quickly gave them up. It was obviously illegal for a while to get a pay raise, to raise the price of a candy bar, etc. That causes a lot of problems in an economy. But he did keep the price controls on oil, which resulted in oil shortages in the U.S. in the 70s, where the oil price internationally was higher than the U.S. price, so nobody would sell the U.S. oil, and commonly you would have gas stations, particularly in the late 70s, running out of gas. Reagan finally got rid of those price controls on oil in the 80s. So Nixon's effort at controlling inflation failed. When Ford took over, he issued win buttons, whip inflation now, and tried to say it was unpatriotic to ask for a pay raise or to raise the prices of your goods. That clearly didn't work either, and inflation just kept going up. Jimmy Carter finally did something that was either altruistic or foolish. He appointed Paul Volcker to the Fed. Paul Volcker really fought inflation by drastically increasing interest rates. He did get inflation under control by causing a recession, which also guaranteed that Jimmy Carter did not get reelected. And inflation was to a large extent under control after that, until we went to zero interest rate policy in the last 15 years. One of the negative side effects of all of this monetary policy instability was the savings and loan fiasco. If we go back to the early 60s, when inflation was low, you could get a home loan at maybe 5%. And what an S&L would do is give you a 30-year fixed-rate home loan and finance it by people's savings passbook accounts. So that home loan is going to last, we'll say, from 63 to 93. If we fast forward here to around 1980, the bank still has a home loan on its books that will still last for quite a while at a 5% fixed interest rate, when inflation is 12% and U.S. government debt instruments pay up to 18% interest. So none of their depositors are going to be wanting to deposit money into their bank at anywhere close to the interest rate that they are receiving on the home loan. So they are losing money because they are being paid in 5%, but inflation is 12%. There's a further complication in this called disintermediation. Regulation Q at that point in time made it illegal for S&Ls to pay anything other than 5.5% on their passbook accounts. If investors were trapped in the S&L and all they could get is 5.5%, then S&Ls could survive. And that was the case for a long time before money market funds. If you wanted to invest in a U.S. government T-bill that might have paid 18% at this point in time, you had to have something like $10,000 to do it. Most people didn't have that money, but the money market funds started pooling people's money and buying T-bills, paying 18% interest, when the S&L could only pay 5.5%. For a while, the government tried to fight this, make it illegal, but people were taking their money out of S&Ls and banks and putting them in money markets called disintermediation. Eventually, it was obvious the S&Ls were just going to go bankrupt, and they shut a lot of them down, bailed them out, and let them merge with other banks. Other ways of looking at the same problem, we can see here at the bottom what is called a normal yield curve. Generally, long-term interest rates are higher than short-term interest rates because you're taking on more risk by loaning money to somebody long-term. But Paul Volcker in 1980 increased short-term rates to the point they were above long-term rates. Of course, an S&L borrows short-term, in this case 15, and lends long-term, and if short-term rates are higher than long-term rates, that's a good way to lose money. The more detailed way of looking at the S&L crisis is duration mismatch. Here we show liabilities, assets, and equity for an S&L. So the equity value is going to be assets in red minus liabilities in blue. The liabilities for an S&L are passbook accounts. The value of a passbook account just adds interest. It doesn't go up and down with interest rates. But as we will know as we study long-term bonds later on, if interest rates go up, bond prices go down. Mortgages are basically bonds. Nobody wants to own a 5% mortgage if interest rates are at 18%. So as interest rates here in the X line go up, the value of the home mortgage is plummeted. So if the blue line, the liability stays the same, the assets goes down in value, then the equity of the S&L would be wiped out. So most of the S&Ls were wiped out. They were merged into banks. There was a big government bailout. And after this time period, securitization became popular. And whether the bank or S&L keeping debts on its own books, it would merely retail them, get people to borrow money from them, and then package that debt and sell it to somebody else. The housing crisis is easier to understand. Say you have a $500,000 home loan at the low interest rate of 1%. Your monthly mortgage payment is $416. The Federal Reserve raises interest rates to 5%. Your variable rate home loan goes up to now having a monthly mortgage payment of close to $2,100. A lot of people that could not afford a payment of $2,100 could afford the $416. They start defaulting on their home loans. This causes lots of houses to go on the market, further depressing the price of the house. Then a lot of homeowners are upside down, where they owe more money than the house is worth. There's no incentive for them to pay, and they just all default on their loans. This again causes the banks to lose a lot of money, and then causes the third set of bank failures on our list. And this was caused, again, right here by all these home loans being made at this really low variable interest rate. And then as interest rates go up, they couldn't make the payments. So during the savings and loan fiasco, most of the home loans were long-term fixed-rate home loans. During the housing crisis, most of them were short-term variable rate loans. Today's banking crises, like what we saw at Silicon Valley Bank, is most similar to the savings and loan fiasco. Silicon Valley Bank went bankrupt due to owning a lot of very safe 30-year government bonds. But as interest rates go up, bond prices go down, and that wiped out the equity of the bank, just like during the savings and loan fiasco. We can see here the housing crisis as we get this drop in housing prices from 2006 to 2012. Since then, of course, the Fed has printed a lot more money. We're back to zero interest rates soon after that, and that causes the bubble we see now in the housing market, which is now the least affordable in U.S. history, and also in the stock market. Eventually, most bubbles burst. It seems unlikely that housing prices will go up from here, or that the stock market will get a very good rate of return from here. So many of these S&Ls and many banks went bankrupt and were bailed out in the 80s. FDIC bailed out all the depositors. We had a lot of bank failures that were absorbed by larger banks, and basically the number of banks in the U.S. went down drastically. This occurred again in 2007, and now we are getting more and more mega banks, which have the too big to fail problem, where basically they don't have to worry about how much risk they take on, because the stockholders will always be bailed out by the taxpayers. And this is called a moral hazard problem. Securitization is now the standard. Most smaller banks and S&Ls just securitize and then sell off their debt. They have less of incentive to make good loans then, because they're not keeping the risk on their own books, and they pass this risk on to someone else. The risk hasn't disappeared. It's being transferred to investors and also to Fannie Mae, which also lost a lot of money and then got bailed out by the stockholders. Currently in the United States, if your home loan is defaulted on and if an entity forecloses on your house, it's basically going to be the federal government, Fannie Mae, which owns most of the mortgages. So most of the houses are indirectly owned now by the federal government. Another problem, of course, of all this securitization is all of these debt pools. Collateralized debt obligations were spread throughout pension plans all over the world, not just the United States. And when all those were defaulted on, of course, those pensions lost a lot of money too. We could have similar problems occurring in the near future. We have housing at its highest cost ever. Lots of people can't afford their houses. Well, they have fixed rate loans and their mortgage payments may not have gone up that much. Their insurance payments have, their property taxes have, their maintenance has, and many of these people can start defaulting on their loans. Of course, lots of entities are dependent on the income from these home loans. For example, in Texas, there are lawsuits going on because the property taxes are being set by what is needed by the school boards and not necessarily the value of the home loans. People are suing, saying my house will not sell for this. If, of course, those property taxes are lowered or people start defaulting on those loans, then the school boards won't be able to make payments on their debt either, and you could have a cascading effect, just like we had in the past during the housing crisis. Not only are houses securitized, car loans are securitized. Before the federal government started taking all the student loans, those were securitized. Credit card balances are securitized. And right now we are seeing a pretty drastic increase in defaults on car loans. So people who have purchased those investments could be losing money. So securitization passes risk around. It removes the risk from the local banks, but then it switches the risk to pension plans, investors, and the taxpayers. To a large extent, ultimately the taxpayers, either through inflation, money printing by the Federal Reserve, or direct bailouts, tend to pay for most of these problems. I thank you for watching this video.